Hello, this is Jim Musgrave, and welcome to the Q2 2022 market update. So the theme for this market update is choppy waters. I love this picture of the sports fisherman boat going through the rough waves, and that's kind of what's happening right now in both the stock and bond markets. So volatility has picked up a little bit. It's not as high as it was in 2020, but you can see in this chart, it just shows you the number of days through the end of February this year that the market was plus or minus 2%. And again, I'm recording this video at the end of April, so you can see in this chart, we've had several more 2% plus or minus days. So as I explained in my Q1 video, that we really expect volatility to pick up, and we certainly came true with that prediction. But one thing I want to kind of point out here, if you looked in the lower right-hand corner of the screen, you're going to see the RSI, that blue line has now kind of gone down below that green horizontal line. And that statistically shows that we've kind of hit at least a short-term bottom. And so the chances are that the market's going to kind of reverse that and kind of go in the up direction. But again, it's all over the place. And you can see right here, this is the worst start of the year for stocks. And again, this is as of the end of February. So as of today, or as of the April the 22nd, the S&P 500 is down over 10%. But you can see on the right-hand side that the following 10 months, there was only 2 years that we actually had negative returns. That was 2008 and 2000. In both those years, we are in bear market recessions, and we are not, I repeat, we are not in a bear market recession right now. We're experiencing volatility and a pullback, but we are still in a bull market. So we anticipate that the market will end up in positive territory at the end of the year. Again, statistically speaking, that's most likely to happen. We've also had the second worst start for the year for bonds. And you can see that at the end of February, the bond market was down, over 3%. But you can see every time this has happened, where the first 2 months of the year were down negative, we've ended up positive. Even last year, where the same thing happened last year. But will this happen in 2022? Well, what's interesting when you look at this chart, I mean, the bond market is down just shy of 10% year to date as of April the 22nd. But again, look at the lower right, you see the Wilder's RSI. The chances are we hit somewhat of a support level, although it could certainly continue to go for some time. But again, statistically speaking, we're going to hit resistance sooner rather than later. And again, why is that? Well, because the 10-year Treasury continues to go up. We're almost at 3% right now, and this is what it looks like on the charts. You can see that the TNX, the 10-year Treasury yield, just keeps on going up and up and up. But again, look at the RSI in the lower right. You can see that it's right at that red horizontal line, which means that the chances are it's going to kind of retreat and start going down in the near future. So this is what we've experienced in the first quarter of this year, but the chances are it's going to stabilize sooner rather than later. Okay, so breaking down the bonds. Again, I did this in my Q1 market update, but again, where you want to be in these periods of times is you want to have shorter duration bonds. You can see the 2-year and 5-year treasuries have done pretty well as the tips. And we certainly have exposure to those in our portfolio. But if you look at the U.S. aggregate, that's negative. The corporates are down, convertibles are down, munis are down. So you can see everything is getting hit pretty hard across the board. But I think there is some light at the end of the tunnel. And why is that? So why are interest rates going up in yields? Well, because the Fed is trying to cool down inflation. And this is the next the slide that I kind of showed in the last video, where we're just kind of showing the progression here, and you can see the areas of inflation that are really getting hit harder. Obviously, energies, new and used vehicles. This is not a good time to buy a car, and we find that food is really been going up, and everybody has felt that over the last couple of years. And I tell you what, if you've gone out to a restaurant lately, I've definitely noticed an increase of price of the menu items. Certainly, my bill at the restaurants is a little higher than it was a couple of years ago. So that we're going to kind of continue to see this inflation. But I think over the course of the year, we should be seeing the inflation start to come down. So whether we peaked right now, who knows? But I think we're getting very close to kind of peaking in inflation. I think we're going to slowly start to see inflation start to taper and go down. But I don't see inflation getting down in that 2 to 3% range anytime soon. Certainly not this year. And you can see that with the interest rates and inflation, again, I show this slide every quarter. And so the nominal yields are going up. We're up to about at 2.32%. But look at the real yields, which is the nominal yields minus inflation. So when you have a high inflation rate and you subtract that from the yield, you can see that the actual yields that we're getting in our CDs and our fixed income is certainly negative, at negative 4%. And what I like about this chart is shows you, if you had $100,000 in a savings account, you'd be making roughly $70 right now. That shows you how little interest there is and how much you'd have to make just to keep up with inflation. So you'd have to earn $6,416 in your $100,000 account just to beat inflation. And you need to make about 24, 30, 29 just to keep up with medical care inflation. So I've been talking about this well over a year, that if you have a high amount of cash in your portfolio, we really need to talk about that, because you're just being eaten alive by inflation. So as I've mentioned in my previous videos, cash is a short-term position. So if you plan on using your cash within 3 months or so, yeah, that's fine. But more, kind of beyond that, you need to put that cash to work. But this is just a great slide that really kind of hits the nail on the head in terms of what you need to be making in your portfolio just to keep up with inflation. Are we in a recession? The short answer is no. We're actually in an economic expansion. I mean, it may feel like we're in a recession, but we're not. The only X that we see here is wage growth, just because inflation is so high. We have the money supply has kind of has given us a cautionary tone, but overall we're still in an expansion and in a bull market. And it's hard to be in a recession when employment is going well and consumption is good. So again, consumption is closely tied to changes in income, both of which have run ahead of inflation in recent years. So again, currently compensation is easily outpacing inflation, which bodes well for above trend consumption continuing into 2022. So this is another reason why we just don't see a bear market happening in this year. So again, the CPI is roughly 7.9, but again, the aggregate weekly payrolls and personal consumption expenditures are certainly higher than that. So that's a very positive economic indicator. And this is not only just in the United States, but across the globe. And what we found is that, when people lost jobs during COVID, there's been a surge of people being hired. And so the current recovery is drawing people back into the labor force twice as fast as the occurring pre-pandemic, which should buoy consumer spending. So, this is where there's a strong labor market, and actually wages are going up, which is a very positive thing for the workforce. So that is again a positive indicator right now. And just to give you some history, when you have a couple strong years after a pullback like we experienced in 2020, typically the third year has slower, returns. So if you look at, March 2009 to October 2020, you can see the year one, the market was up 68.6, year two over 15, and year three was just under 4%. So that's definitely the trend in the third year when after, 2 strong years of a recovery. So this is kind of be expected, and this is what the chart looks like. What we're kind of predicting kind of moving forward for 2022. Obviously, we're down right now, but again, the chances are that the market's going to end up on a positive note year end. And again, you layer on another layer of the midterm election, and just historically, even if we weren't going through this crisis with Russia and Ukraine, and we weren't rising interest rates and going through this situation. Just being in a mid-year election tends to bring up volatility in that regard. So how do you position your portfolio? Well, we always think strategically. So what's moving the markets right now? Well, obviously, the invasion on Ukraine has had a huge impact on world markets, primarily energy and commodities. And so you can see that there's been a demand for oil. The West has obviously put sanctions on Russia. We're trying not to buy oil from Russia, which kind of it's the whole idea of supply and demand. If you look at the lower left-hand corner, you're going to see that the oil inventories have been dropping, but fortunately the active rigs are increasing. The thing is, when you're dealing with oil, you just can't turn on production overnight. It takes a while to kind of ramp up. So that's really important to kind of understand that. The other thing is that with this invasion of Ukraine and the world not wanting to be dependent on Russia, there's been a renewed interest in renewable energy. And if you look on the right side, you're going to see that the actual cost of wind, solar, and again, natural gas has really continues to drop over time, which is very positive. So, right now, we certainly have exposure to both your traditional energy in our portfolio, but as well as clean energy. So I think the energy sector is definitely a place to be right now. It's one of the few sectors that's actually made money this year. And you can see on the left-hand side, commodities. I just mentioned that the commodities have been a positive asset class this year, and you can see that the prices continue to go up. I think the only one that's down in terms of commodities are livestock this year, but everything else is up. The commodity index is up: silver, agriculture, crude oil, gold, natural gas, industrial metals. And what's interesting is that you look at on the right side the contribution of global production of commodities for Russia and Ukraine. So Russia is a huge producer of palladium, natural gas, and so forth. And so there's certainly opportunities for companies and countries outside of Russia to kind of find and enhance their production of these commodities. So if you're looking in when we're going through these periods of times, when the Fed is kind of raising interest rates, or we go through these these volatile times, if you look at the sectors that do well, let's say 6-12 months out, technology has historically done extremely well, followed by healthcare and utilities. And towards the bottom of your screen, we've seen that growth outpace value historically. So this just gives you an idea on if you're going to take a tactical tilt to your portfolio, having some exposure to energy, information technology, and also to growth are a number of areas that we feel that should do well in the upcoming months. And again, this is another chart that shows, again, the equity leadership during these times has tended to lean towards larger growth, more growth-oriented segments. And again, small cap value tends to be the underdog in this environment. So again, if you're heavily invested in the S&P 500, that's not a bad place to be right now. So we certainly have exposure to large cap value, but we're going to kind of start to kind of lean a little more towards the large cap growth areas. So what do you do if you're going to take a tactical tilt in your portfolio? Well, as I just kind of mentioned, large cap with a slight growth tilt to it. Energy, commodities, and technology are three sectors that you should have some exposure in. Again, bonds are super tricky right now. Keeping your duration short, having tips. One thing that we've kind of worked into our portfolio is tactically managed income funds that give the portfolio managers a lot of freedom to kind of navigate these choppy waters. And now's not a bad time to have a slightly higher cash position in the fixed income portfolio. As I said, the RSI is kind of showing us that the interest rates and the bond may have kind of peaked at the moment. So, you got to be careful with the amount of cash in that and know when to kind of make use of that dry powder in the portfolio. So action steps. Again, we can do a complimentary portfolio review. We've got great software where we can show how your portfolio will perform in different economic situations as interest rates go up, all sorts of things. And also, how are you positioned to minimize losses? Do you have inflation fighters in your portfolio? Do you have exposure to energy and commodities, possibly some aerospace and defense in your portfolio? So that's an important thing. You may not even have the positions in your portfolio that will help fight inflation. So you need to know that. Have you had the same allocation for over a year? Well, this is a huge, red flag right here. If you haven't adjusted your portfolio in the last year, there's some real dangers of doing that, and there's a big opportunity cost by not taking that tactical approach and minimizing losses in these times. And also, how does your portfolio compare to other similar portfolios? Again, we can do that with our portfolio analysis. How are you doing, or how is you and your advisor doing compared to 5,000 or 6,000 other portfolios that are similar to yours? The other thing too is that we just passed tax time, and writing that check to the IRS or submitting those taxes, I always find that it's good to look at your portfolio after you've written a check to the government. So now is a great time to review your portfolio for tax efficiency, especially in your non-qualified accounts, your taxable accounts. Are you taking advantage of tax loss harvesting opportunities? Okay. And also, I've talked multiple times about Roth conversions, and we still recommend to do those on the pullback. So again, that kind of wraps up my Q2 market update. So feel free to schedule a 30-minute call. There's the link to my calendar. You can give me a call. You can send me an email, and I'd love to hear from you. And again, if you're a client of mine, I'd love to do a review and kind of see how things are going. If you're not a client of mine, then let's see how we can potentially help you. We're always able to compare our money management and our planning services to help you compare and contrast what you're doing with if you're not working with an advisor, or if you are working with an advisor. So we'd love to hear from you. So until Q3, I hope you guys have a great Memorial Day weekend and coming up in May, and also get your summer started off on the right foot. All right, we'll see you then. Take care.